Hey everybody, we are back with Ben Axler from Spruce Point Capital. Ben is a little bit of a short factory. He's got I don't know how many short this portfolio. He's definitely built brand as being sort of an expert on valuation and finding froth in the market, so to speak. So Ben, great to have you back on SumZero. Since we last spoke, or the last time we spoke, you kind of went through quite a lot of I think detail on Oatly. So maybe first, before we get into Lightspeed, can you just get us up to speed on Oatly, how that's done since our last conversation, and any new material updates to the business?
Sure. So, Oatly reported their first quarter. They didn't give any margin guidance, and we've been harping on the fact that the competitive landscape keeps getting more difficult. And in fact, recently we found their ice cream at the lowest price ever at grocery outlet for $1.99. And in addition, new plant milks are hitting the market. We had warned about Jeff Bezos and Amazon backing not milk, and we recently found that at $2.50 per carton. Oatly sells its oat milk at $5 per carton. So now you have more breadth. You have clear evidence of discounting. Margins are coming down. Companies not giving guidance. They spoke a week or two ago at a conference and gave no color on the quarter. So the stock's lingering at all-time low. We have a $5 price target. We're still short. It's one of our higher conviction shorts, and we look forward to the next quarter or two when management has to meet some pretty aggressive sales goals and margin targets.
Ben, did you have a carton of not milk on you?
Yes, actually, I like it. It's a pea milk, so it's a little bit different from an oat milk, but it has less fat, no added, fewer sugars.
What grocery store did you find that or pick it up from?
Well, it's at Whole Foods now, but this is at Stop and Shop. They're running a promo,
Yeah.
2 cartons for $5.
Incredible. Well, let's move on to Lightspeed. I know this is a name you've done a lot of work on. Maybe just start with kind of the high level on what they do, where they trade, what the market cap is right now, and just kind of a quick, very high level overview on your views on the business.
Sure. So, Lightspeed is a Canadian origin company founded in 2005 in Montreal by Dax De Silva. Went through some VC capital raises, came public in 2019 in Toronto, and then subsequently onto the New York Stock Exchange. Their basically origins are point of sale, hardware solution, right? So you go into a restaurant now, and all the restaurants have those little iPads where they type in the orders and optimize the seating, and that business has become pretty commoditized. This Lightspeed used to make money selling the hardware and the subscription. Now the past 3 quarters, it's evident they're losing money on the hardware, and the subscription policies have also changed. Initially, customers would pay upfront for multi-year contracts. Now the market's moved. Now you pay monthly. And as part of that, now they're also trying to sell a payment solution, to the retailer. And by the way, their mix is, restaurants, hospitality, retail. Now they're trying to add on a payment solution, which they've been promoting pretty heavily. They don't give a lot of metrics around how many people are actually using it. For a while, they weren't really disclosing, breaking out the revenues and the margins. They just did a quarter ago, and now we see that the margins in that business have compressed 2,500 basis points. So, this is a, high level, Divya. This is a very intensely competitive industry. They're competing against the likes of, NCR, Oracle, Toast just came public, Clover, you might have seen, Square. Obviously, Square, right? Shopify is also giving point of sale devices. And so they're having to transition their business. And part of our concern now is that they've gone on a very expensive acquisitive spree, spending over $2.5 billion to try to build more of a omni-channel presence and more of an e-commerce solution to be the everything for the small, merchant. And that's a more difficult transition to become like the next Shopify, where their core competency was in POS, systems to become like an omni-channel e-commerce multi-solution for a business. And that's where we think they're really going to struggle and fail, because they're now up against bigger players, Adobe, et cetera. And now Amazon is rumored to get into the POS space. So we have a lot of concerns. That's high level. I'll stop there. But
yeah, I mean, maybe it'd be helpful to break up the revenues a little bit. Like, what is their biggest contributor to top line, and what is their model? What do they charge for that service?
Yeah, so it's they make most of the money on the software, right? So again, initially they would sell the hardware. Now we learned that they're pretty much giving away the hardware, and trying to bundle everything together. And part of the concern now we've learned as part of our process, we talk to former employees, that they can actually lose money, because there's in many cases no obligation to use, for example, the payment product which they're giving away as part of a package. And so they could be absorbing a couple $100 in cost up front and getting no return on that. And then they have a monthly subscription, and they try to sell various add-on solutions. However, most customers use one or two add-on modules. They say that that's been increasing. They gave some information up front in the IPO about how many customers use 1, 2, 3 modules, and then they stopped that practice. And then now the payments, right? I mean, payments is a big opportunity, right? There's trillions of dollars of payments going on every day, and they talk about this metric called gross transaction volume, a metric that we believe is at least according to one employee, smoke and mirrors in terms of how they present that. But they would claim they have billions of dollars of GTV flowing through their platforms, and that their payment solution, that they have an opportunity to get 10, 20, 30% of that and take a small margin on that, and that's the big upside. But again, I think we have concerns about the GTV metric, even concerns about the actual customer counts. We found a lot of evidence of revisions of metrics, average revenue per user, that definition changes 3 times. So we're really trying to understand what's going on with this business, right? They're not transparent about organic growth. They've done so many acquisitions. They don't break out revenue contributions from acquired businesses. So, we have to look at balance sheet allocations from recent transactions, and we see evidence of double-digit organic decline in the business. We see evidence of a very low quality customer base. We look at the allowance of bad debts as a percentage of gross receivables. It's on the order of 20%. You look at Toast, you look at NCR, PAR Technologies, other pure plays. They're reserving about 5%.
Is that because they're dealing with a much smaller shop typically? Like, what is their average customer profile? What's a typical customer profile look like?
Yeah, so initially, they started, and they would say like complex retailers that, and they had a good inventory management system, but these are mostly small businesses, right? And part of the challenge,
like a cafe or something.
I'm sorry.
Like a boutique cafe, maybe, or
exactly, doing under $1 million a year in revenue. Very, very small businesses, very high default, high bankruptcy rates, and part of this also is that Lightspeed absorbs a lot of that risk, and particularly on the payment side. That if some of these retailers go belly up, they're on the hook for that. And the world's changed, post-COVID, right? We definitely have a trend that we've learned, again, talking to former employees, talking to the industry, of retailers shrinking their locational footprint, fewer stores, right? And obviously moving towards a more e-commerce model. And, that's a negative for Lightspeed because they've never really had a good, strong e-commerce solution for businesses, and fewer locations and fewer touch points is also a negative for them to deploy more of their hardware and software at various touch points. So the trends have sort of moved against them, and that's why we think they've had to go and spend $2.5 billion on acquisitions to try to remain competitive and relevant.
Were those stock for stock deals, the acquisitions they've done for the most part?
A lot of them have been a mix of cash and stock. So, there's been a lot of dilution here in this business. The insiders have been selling. Not only have they been selling stock, the CEO and others, but because of all the stock issuance that insiders obviously have been diluting their position as well. So there's a lot of stock out there. Part of our concern, obviously, some of the analysts haven't modeled, the stock correctly. They have one pending deal that's set to close. Actually, they said today, if that doesn't close, that'll be an interesting develop. That's called Equid. They're going to have to issue another couple million shares for that. So, part of our research, we felt the enterprise value is about $1 billion under modeled. If you look at Bloomberg or Yahoo, some of the data sources just aren't up to date and accurate.
But so the market cap that I saw on Yahoo is like around 22 billion or so. Is that
that's
close?
probably Canadian. That might be Canadian. As of the date of our report, the enterprise value is about $17 billion. So we're talking about a company that's trading at was trading at 23 times revenues, and we can talk about valuation, but that puts it up in the upper stratosphere of its peers, like a Shopify, Adobe, and these are guys that generate cash flow, positive EBITDA margins. We have no evidence that Lightspeed has generated $1 of cash flow in 16 years in existence. Why would anyone want to pay 23 times? Now, if you could tell me that they were growing organically 80%, then okay, maybe, but you can't deduce that from the company's disclosures. They make it very difficult and to figure out what's the real organic growth here, given they've bitten off, 8 acquisitions in the past, 18 months or so. So that's where we sort of quibble with, like, what is this business really worth? And we think this is more of a 6 to 12 time business. The payments revenue is growing as a portion of the total, but that margin keeps decreasing. It's a very low margin business, and management has not been transparent about what the end margin targets are for this business. And it's also a higher risk business because, again, on the payment side, they have to absorb all these small, medium business customer risks they're on the hook for. So we don't think it's a great quality business. So we see this more of a...
What exactly is the mechanics of their payments business? Like, what are they charging for? What's the trigger for the fees that they make?
They've disclosed it. It's like 2.7% of the gross transaction value, but then there's a cost associated. So net, it's like 75 basis points. Don't quote me, but it's something on that order. It's a pretty... Again,
is that on top of like the credit card fee that a customer would pay, or how does that work?
No, I don't think Lightspeed gets any of the credit card. They're just sort of passing that on, right? Or the merchant processor and the mechanics there. And they also get a small transaction, maybe 10 cents transaction, something like that. In talking to a former employee, there is some sort of incremental cost there, but it's very hard. We tried to back into the number, like they report a payments revenue number, and with some of those assumptions, we couldn't exactly reconcile that number. But it's a small percentage of the transaction plus a per transaction fee.
Yeah, well, one of the things I think you had mentioned in your report was you sort of questioned the actual number of like customers they have. What did you find on that front in terms of what they're reporting versus what you're sort of backing into based upon sales and other metrics?
Yeah. Well, I mean, look, we find irrefutable evidence here that the business was stalling up until it coming public, okay? And what we did was we did a web scrape using the Wayback Machine. Month by month, the company would update how many customers it has, what is its total gross transaction volume that it's processing. And looking at these numbers, what did we find? That the gross transaction volume per customer was in steady decline. And then about 6 months before coming public, the company stopped providing any customer metrics or GTV metrics. And then at the IPO in the prospectus, we see what they disclose. And one of our concerns here is that they were saying they had 50,000 customers. But then the IPO prospectus talks about 47,000 customer locations. But they left 2 clues. They did say that their average revenue per customer was $200 per month. So you can annualize that and you can back into how many unique customers they had. Same thing, they said each customer did 500,000 of GTV. So, we estimate they really had about 27,000 unique customers, whereas they're out promoting 50,000. So something's not adding up here. Now, also, let's look at the TAM. As we know, companies coming public, they love to promote, a multi-billion-dollar TAM to get investors excited. They were citing a number over $100 billion TAM, right, at IPO. And now the recent prospectus is showing a $16 billion TAM. So how is it that after you spent $2.5 billion of acquisitions, you claim your ARPU is rising? Why did your TAM go from over 100 to 16? And by the way, if you're saying your current TAM is 16 billion and your enterprise value is close to that, well, that to me means you're pretty fully valued if you're already valued at your current TAM.
Yeah, that's really interesting. I wonder if that has something to do with like a reassessment of the competitive landscape or something or maybe just the margin impact, the compression that they're seeing on margins is being one of the reasons why the TAM might fail.
I just think there's a pattern here. See, I like to invest in management teams that are transparent upfront and do what they say they're going to do. With Lightspeed, we found 3 revisions to their ARPU definition. They didn't call this out. We had to meticulously go quarter by quarter to find this, right? They initially said cash flow was the best way to monitor the growth of their business. They suspended that, and then they waited a quarter to tell you that they suspended it. And then lastly, on their acquisitions, they've said, oh, we want to buy high growth businesses. We don't buy legacy businesses. We disagree 100%. I mean, we look very carefully at their recent acquisitions of Shopkeep and Vend and Upserve. And again, using the Wayback Machine, we dug to see like what were these companies claiming their growth was. And many of these businesses had peaked. We could see a clear peak in either their customers or their GTV claims. And so, they're saying one thing and they're doing another thing, and then they're giving you information and changing it without calling it out and bring it to your attention. And that's just not a business or a management team I want to invest with.
Yeah. So speaking of that, what have you learned about the CEO, CFO, and just other folks, at the C-suite level that, might have been a red flag for you?
Yeah, so I think, look, founded by Dax De Silva, entrepreneur, no real red flags on him. The CFO, we do have a little bit of concerns about. Brandon Nussey, he came from Descartes Systems Group a number of years ago. He said he held a bunch of various roles, and then he became the CFO in 2000, and I think he said 2002 or 3. We actually found out it wasn't 2004 he became CFO, so there's questions about when he really became CFO. And then we dug back, and he held a senior operational role at the company. Now Descartes Systems is interesting because it like Lightspeed was a software roll up that fell on operational hardship. They bit off more than they could chew. Eventually they did accounts receivable restatement, goodwill impairment. So they had a little bit of scandal. He became the CFO. They turned it around. Why would you bring in a guy like that as your CFO? We question this, right? Like, why do you need a guy that went through a scandal and a turnaround to bring him into Lightspeed? Like, it just seems a little bit of a unusual choice for us. And so, there's some, red flags there. Also, their senior sales guy left, Julian Teixeira. They never disclosed that. We didn't find any, quote unquote, 8K filings in Canada, related to that. So they had a senior sales guy leave. They didn't disclose that. So those would be the bigger, red flags. And like any other company, I mean, they've had normal turnover, just given the growth of the business. They've acquired a lot of businesses. So when you're acquiring people, you bring in people from different cultures and integrating tech systems. I mean, company would have you believe they've done seamless acquisitions. Obviously, based on our employee interviews, not everything they've acquired was easy to integrate, and some of the things they even acquired they aren't necessarily using anymore. We did point out they changed their impairment. So Lightspeed changed their impairment testing to make it more difficult to trigger an impairment. That to us is a red flag, given our understanding that some of these acquisitions haven't gone well, and then them potentially kicking the can for impairing things. So there's red flags like that we see. And again, we think they're delaying problems with businesses they acquired.
On the revenue recognition side of things, can you just walk us through what you saw there that might have been concerning?
Yeah, I mean, they post their prospectus, they loosened a little bit some of the language in terms of their revenue rec. They, are very specific about things, and the language changed a little bit that maybe would allow them to recognize revenue quicker. We definitely know for certain they acquired two businesses that where they harmonized the targets accounting from what is it, principal to agent, that would then allow them to recognize, gross revenue versus net revenue. That for sure artificially boosted some of their recent revenue. So we know they've done that, and that's a little bit deeper in our deck. So little things like that. I mean, question some of the true organic, like what's the true organic growth rate, right? Like you're making accounting changes, you're buying things, but not disclosing revenue contributions. And the other thing is they're a multinational business, right? They have revenues in Switzerland, Germany, Australia, US, Canada. They don't tell you what's the FX, what's the foreign exchange impact on revenues, right? I think about 40% of their business is outside the US. So, why can't you tell us FX impact on revenue? There's these things that give us concern about revenue quality.
So, and somebody had asked this actually within the SumZero community. What do you think is driving the stock up or down? Like, what would you say are the key, like the most important KPIs that are going to move this stock up or down?
Yeah. I mean, look, it's highly correlated to Shopify. Full disclosure, we're long Shopify as a hedge. We think it's a better business, obviously, and we think that Lightspeed is going to have challenges trying to compete against Shopify. But I would say, look, their business is very tethered to the consumer and discretionary spending, right? They have restaurant clients, hotel clients, retail clients. So the health of the consumer, not just in the US, but abroad in Europe and now Asia, perceptions about spending patterns, perceptions about their ability to penetrate market share, things of that nature. Like so, it trades more like a payment and a payment company. And we think it should actually, and obviously get a lower multiple because that's where at least their revenue growth is becoming bigger, more on the payment side, obviously less on the hardware side, which we said the margins are going down. But yeah, this is really a play on the global global consumer, global small businesses, restaurants, retailers, hospitality companies.
Yeah, I mean, it sounds like as long as the reopening trade is alive and well, maybe the stock kind of holds itself up. But I mean, is there like beyond earnings? Is there another potential catalyst here that you think could really drive the stock down? Maybe it's competitive announcements or whatever. But what do you think is in the pipeline of call it 6 to 12 month catalyst?
Yeah, well, no, that's a great look. That's a great question. In fact, we think all the catalysts are behind them, right? They've just announced New Order, Equid, Shopkeep, Upserve. They've announced a flurry of large deals, and so now I think they're done in the near term. Now they have to show investors, like, what are you doing with all these acquisitions? Like, is this going to work, right? Like one former employee we interviewed said it best. It's like these guys are good at PR, they're good at marketing, they're good at putting a nice deck together that shows what they want to be. But now they've bitten off all these companies. Now, is it going to work? Like, can they make sense of everything they bought, right? I mean, every time you buy a tech company, there's different tech platforms and different people speaking different languages in terms of how do you get this all together? How do you make sense of it? How do you generate value out of all this? So now we think is a great time to be short because they have to now show that they can extract value after spending $2.5 billion on these deals.
Yeah. Another question that we got was just on revenue and gross profit estimates for next year. Any sense of like when you were modeling the business out, how your projections compared to the streets?
Yeah, look, we're not macro economists. I have no view on whether COVID's going to accelerate, decelerate, whether we're going to have a faster, slower reopening. I have no view on how quickly the Fed's going to taper or raise rates. Obviously, that's sort of a little bit of a macro bet. I do have a strong view on a few things. Number one, obviously the multiple at where this business is trading, I have a strong view on. But I will say that part of what's driven the stock, obviously, is investor enthusiasm about their ability to beat revenue estimates. But no one talks about the fact that they've wildly disappointed on the gross margin targets. I mean, I think last quarter they missed gross margin estimate by 750 basis points. I mean, the analysts here, to me, like, why would I trust any of these analysts that have these wild targets when their modeling of the business has been woefully inaccurate? And I do have a feeling, I have a strong feeling, a gut feeling that management is heavily massaging their estimates here. I mean, first off, they're one of the few companies in their space that gives quarterly revenue guidance. Most of the other companies still aren't giving quarterly revenue guidance. So these guys are, number one. Number two, they're giving very narrow quarterly guidance. So setting it up in a way that we think allows them to beat the numbers. They've also bought a lot of businesses. We've found one instance where some of their revenue disclosures about two of their acquisitions didn't add up. So they could be managing the revenue guidance in a way that allows them to beat it. But, you know, revenue is one thing to look at. I look at, is this high quality revenue or not, right? And it's very clear to me, at least looking at the numbers, that it's low revenue quality because the margins keep going down and down and down. And if I'm focused on what's this company earning, and are they generating cash flow, the answer is no. And so this to me is just a low quality revenue growth story that investors have gotten excited about. But at some point, like any business, you know, cash flow is going to matter. And the question will be, do you generate cash flow or not? And as I said, after 16 years, there's no evidence that they have been able to generate cash flow.
You said earlier that it's really hard to tell what their organic growth rate is on top line.
Yeah.
Is there a range that you feel like they're probably in? Like, I mean, is it like 10 to 20 or 30 to 50? Or I'm just curious if you have some idea what they're actually doing, you know, just ballpark.
I mean, look, we think they're declining organically double digits. And we looked very carefully at some of the recent acquisitions and some of the balance sheet allocations to deferred revenue and accounts receivable. And if you back out, you know, acquired receivables and acquired deferred revenue, you know, you find evidence of double digit quarter over quarter, in some cases quarter over quarter, year over year decline, right? And I'll also mention, you know, again, we talked to a former employee who had been there over 5 years. He was one step removed from the C-suite, and we asked him about, you know, hardware trends and margins, and he said obviously they're going down, but then he told us ARPU as a whole is going down. And that struck us as just like my jaw dropped, because management claims that ARPU has been stable and growing. Mm-hmm. So if ARPU is going down, if margins are going down, if, you know, accounts receivable X contributions for acquisitions are going down, then something here, you know, looks like it's going down pretty sharply.
Who from the sell side is covering this stock?
They're covered by a lot of Canadian banks. Obviously, they have Canadian origins. There are a few U.S. banks. Look, from our experience, and we have a lot of experience in Canada, the Canadian banks are very promotional with their own domestic companies. You know, if you're looking at a tech company or a transportation company or an aerospace company, like when we read the reports, it's always like, oh, the Canadian company is one of the best in the world, and this is the best Canadian tech company, or it's the best Canadian transport company, or the best Canadian aerospace company. So they have very high price targets, all the way up to 150 per share. And notably, the only real skeptic is a firm called Veritas, which is not paid by management through fees. They're not an investment bank. They're independent, and they have like an $80-something price target. So, you know, you have the one independent guy who's the general skeptic, you know, research firm in Canada, all the way down here, and then you have everybody else, you know, up here. And obviously we're even lower than, you know, Veritas. So I think it's, you know, that's sort of the spread of what people think. But on average, you know, the brokers think it's $120 stock.
So when you you arrived at like a 6 to 12 times sales multiple. Can you just explain how you came to that? As you know, even a 6 to 12 times multiple is pretty high. So I'm just curious what your rationale was.
Yeah, sure. I mean, pardon me, if you pull up our slide deck, slide 124. I mean, look, on average, if you look at the Adobes, the Shopifys, the Squares, the Toasts, the payment companies, some of the legacy ones like PAR, NCR, Agilysys, I mean, on average, your multiple for next year is 8%. You know, most of the industry is looking to grow 17%. Again, we think that they're probably going below average. In fact, as I said, we think they're probably organically declining. Hard to figure out again, as we mentioned, but yeah, I mean, a 6 to 12 kind of multiple is sort of in the range. You know, with the average multiple in the industry right around 8, they probably deserve to be below that. But you know, at a 6 to 12 sort of range on again, just taking the street's revenue estimates, you know, we get 60 to 80% downside.
We had a question on payments. Uh, this person wanted to know what gives you conviction that the payments penetration won't move towards their target over the next couple of years.
Yeah, I mean, payments is it's just super competitive. I mean, everybody and their mother has a payment solution, right? And again, we know they're having to give it away, or at least incentivize people to even try it by giving away the hardware. And you know, they claim so. You know, again, pointing out the key performance metrics. I think way back when, a number of quarters ago, they used to disclose a metric, payments adoption rate, and they had it defined. They gave it to you for 1 quarter, and then they ceased disclosing it. Now they're talking about, you know, payments as a percentage of penetration of their GTV. And my God, you know, we went through great lengths to kind of show that this GTV metric, you know, as one employee says, is smoke and mirrors. So it's really unclear. I mean, they probably have scratched a small percentage of the surface. I know they're trying hard. It probably will grow. Again, you know, it'll certainly help them grow revenues, but we don't know where the bottom is in terms of the margins, because the margins keep going down. And in fact, last quarter they went down a lot, so we expect the margins to keep going down on the payment side. And but who knows where the bottom is there.
And has the company been publishing double-digit organic growth?
Well, you know, again, you look at their press release even last night. So, you know, we wrote an open letter to management. We posed, I don't know, 10 questions of, hey, explain this, this, and this. They came back with a boilerplate response saying we're wrong, didn't point out where we're wrong, number one. Number two, they then said, for quality information, go to the SEC and CDAR for information. Well, I mean, we pointed out errors in their filings. And take a step back, even in addition to that, we found evidence of them filing some information in Canada, but not the US. So, you know, again, they're making it difficult for investors to have the same information in the same market. But then, you know, they said, oh, our organic growth rate for software and payments is X, but they don't talk about what's your organic hardware, what's the total, you know, what is the total organic picture here with acquisitions and currencies? Just tell me, like, lay it out, bridge it for me so that I can understand. You know, had they really wanted to rebut us and try to be more transparent, they could have done this quite easily overnight, but they didn't.
Here's a great question. Competitors like Square and Toast have 100% payment adoption and negative hardware margins. What's different at LSPD?
Well, yeah, I guess we don't really know if Lightspeed has 100% payments adoption. I would think they're pushing it pretty hard for any existing and new customer. The margins, I think, you know, the key is that the hardware margins used to be positive, right? So this used to be a profit center. Now it's a cost center, and that's obviously a negative inflection for this business, for the whole industry, right? It's pushing everyone down, and that's not necessarily good. If I'm an equity investor, I don't want to be in an industry where it's a race to the bottom.
Is there any differentiation with respect to the hardware itself? Like when you get like the Square POS system versus this one, like what's actually different?
Not sure, to be honest. Yeah, I mean, I think it's kind of hard to generally differentiate on hardware, but in terms of the nuances and specifics, I did
Yeah.
not research
Is
that.
there anything about the Lightspeed supplier network that's worth noting that might result in some differentiation, or is that also something that the other POS providers offer?
Unclear. Yeah, that's something we haven't researched.
Cool. Any other kind of, I don't know, Ben, like you tell us what the main takeaways here are if you want to just summarize it. I don't want to beat a dead horse, but
Yeah.
any final takeaways?
No, I mean, look, our opinion is this is a classic Canadian roll-up stock promotion. And the story that they're telling investors is different from what we're learning talking to former, employees. And that's and not only that, like the messaging that the company's saying, like whether it's, what they're looking for acquisitions is different in practice. And again, I have trouble not only, investing in management teams that are saying one thing and doing something else. I have a problem investing in management teams that are constantly shuffling the goalpost and then not making it fully transparent. These are management teams we want to short, particularly at these valuations in this environment. Obviously, a macro environment where now we think the market's going to get a little more selective as rates rise, and we have this tapering discussion. I want to be short low quality technology companies at high valuations that don't generate cash flow. And so that's the takeaway. If you need to find a short, you want to short the most overvalued and the weakest, lowest margin cash incinerating company, and that is Lightspeed.
That's Lightspeed. Actually, one thing you mentioned earlier that I thought was fascinating is that you're actually long Shopify, which many value investors would say, might argue that it too is one of these high flying stocks that is probably ahead of its skis. Would you be long Shopify if you were not short Lightspeed and some of these other Canadian names, or
No.
or you would not be? Okay.
No, but look, I mean, we have to hedge our positions. I mean, they're highly correlated. That's just how the market is. I mean, they're both Canadian tech companies. They're both in the same, going after the same customer base. But if I had to be, and at least it was a few days ago, they were both comparably valued on the same multiple basis. So if I have to choose a winner, and I do think Shopify will win in this space, they're already dominant. It's let's not forget it's Lightspace who's having to go towards Shopify customers, right? Not the other way around, because we think that the market has changed, and we think Lightspeed has more or less targeted most of its customers. It's having to go down market, and that's more towards Shopify, which has some somewhat smaller merchants, but they have an easier to use e-commerce solution. I mean, on one of our interviews with a former employee, we asked him, what would you choose if you were a small merchant starting out and you had simple needs? What would you choose? Would you choose Lightspeed or Shopify? And he said Shopify. He's like, Shopify is something that it's a solution that if you're small and you eventually grow out of that and you grow into Lightspeed, but if you're starting out, Shopify is a good solution. And he said he would recommend people start with Shopify. So
it's anyway. Funny you say that, because I was on YouTube and I was watching some of the Lightspeed promotional videos, and they were all like single, these like kind of mom and pop entrepreneurs that ran, like a guy who runs a bike shop, a woman who runs like a skincare retail shop, and and that was my first thought. It's like, oh, like wouldn't these people typically be on Shopify or some other platform that's kind of meant for these smaller operations, the sub $1 million revenue shops? So maybe that's something that they've marketed around a lot, and have been kind of pushing that message, but aren't necessarily built for. Who knows?
Yeah, no, it's interesting you mentioned bike shops, because one of their early acquisitions, I think it was Merchant OS, like had a very strong positioning in the bicycle industry. So I think they started initially, when they went down this path of growing in acquisitions, their legacy was for bike retailers and bike shops. and also they bought a business in the golf industry too, Chronogolf.
Yeah.
So there's some, maybe a little extra risk profile you're taking to bike shops, and which aren't really growing in Canada anyway, and golf, golf courses, which also is not a high growth industry. There's some percentage of revenue, it could be 5%. I don't know exactly, but some higher than normal exposure to bike shops and golf courses when when you buy into this story.
What's the story with insider selling, if any?
Yeah, I believe insiders, again, have been reducing their position through natural dilution as they've been issuing equity for transactions, but also, the company came public in March of 19. So, I mean, there's no lockup restrictions that I'm aware of at this point.
Got it. Ben, this is great. I'm going to keep track of this one and put it on my watch list. Looking forward to the next one. Thanks for taking the time.
No, thank you. Always a pleasure. And, stay safe, everyone. And happy hunting in the stock market.
All righty. Thanks, Ben.
Take care.